Hello and welcome back. This video presents a MACD with CCI strategy that is claimed to work well online, making it a potentially good choice for an algo trading experiment. We'll explain the strategy and backtest it on historical data, hoping to achieve good results. If you're interested in algorithmic trading, consider subscribing to our channel. Let's get started. The strategy operates on a 5-minute time frame, utilizing the 1-hour 50 EMA and 100-hour EMA to identify the trend. When the 1-hour 50 EMA is above the 100 EMA, we are in an uptrend and can consider long positions. Conversely, if the 50 EMA drops below 100, we avoid entering the trade. The entry signal is determined by the MACD. When the MACD line, the blue line, crosses above the signal line, the orange line, and both curves are below the zero line, we have a strong entry signal. To increase the win rate, we also incorporate the CCI indicator. We only enter the trade when the CCI is below a certain number, typically near the oversold area, to detect reversals. We use a minimal ROI to exit the trade. If the trade reaches a fixed percentage of profit, we will exit the trade. Furthermore, we will exit the trade when the MACD line crosses below the signal line, while still above the zero line, and the CCI is above a specific number, indicating it is near the overbought area. If you're unfamiliar with the MACD indicator, here's a brief overview. The MACD line, the blue line, is the fast-moving average, while the signal line, the orange line, is the slow-moving average. The histogram represents the difference between these two averages, and the zero line differentiates the positive and negative values of the histogram. We enter a long position when the fast curve crosses above the slow curve below the zero line. We exit the trade when the fast curve crosses below the slow curve and they are above the zero line. If you're not familiar with the Commodity Channel Index, CCI indicator, here's a quick overview. The CCI is a momentum-based oscillator used to identify overbought or oversold conditions in an investment vehicle. It's considered overbought when above 100 and oversold when below 100. We enter a trade only when the CCI is below a specific value, indicating a nearly oversold condition. We only exit the trade when the CCI is above a certain value, suggesting a near overbought situation. We will apply this strategy using Python's Freqtrade and backtest it on historical data. For this video, we'll use a 5-minute time frame. Feel free to explore different time frames if you're interested. The parameters will be optimized on a portion of data, then tested on future or unseen data, also known as out-of-sample data. This method provides a more accurate estimate of the strategy's performance. We'll trade perpetual futures contracts for 20 cryptocurrencies with large market capitalizations, with a maximum of 5 open trades at a time. Now, let's begin with the coding part. In this strategy, we use a 5-minute time frame along with a 1-hour time frame for the informative time frame. The 1-hour time frame aids in trend detection using 50 EMA and 100 EMA. The strategy is mainly focused on long positions. To get the best results, we use optimization for minimal ROI and stop loss. This strategy does not employ a trailing stop. We use the Freqtrade recursive analysis command to obtain a reasonable startup candle count, which is 300 in this case. We optimize 2 parameters, the buy and sell CCI thresholds. For the buy CCI threshold, we test values from -100 to -40 to identify the threshold value that yields the best performance. Similarly, for the sell CCI threshold, we examine values from 40 to 100. To enhance trading efficiency, we employ different leverage levels and test them to obtain the best results. Next, we have the plot configuration. Though it is optional, it can aid in the analysis of backtest details for each trade. On the main plot, we have a 1-hour time frame for both the 50 EMA and the 100 EMA. Additionally, we have 2 subplots, one for the MACD indicator and another for the CCI indicator. Next, we establish a 1-hour time frame for each pair listed on our whitelist. This is done to provide additional information for our trading decisions. Following this, we proceed to populate the 50 EMA and 100 EMA indicators on this 1-hour time frame. For the populate indicator, currently set to a 5-minute time frame, we calculate the MACD and CCI indicators. Within the populate entry trend function, we use the MACD and CCI indicators to guide our trading decisions. A long position is initiated when the MACD line, the fast-moving average, crosses above its signal line, the slow-moving average, provided both values are below zero. This indicates a bullish trend. In conjunction with this, we check the Commodity Channel Index, CCI, which should be less than the buy CCI threshold value, indicating it's near its oversold level. We also ensure that the 1-hour timeframe 50 EMA is above the 100 EMA to confirm it's an uptrend. Additionally, we ensure that the trading volume is above zero. In the populate and exit trend, we exit the trade when the MACD crosses below the MACD signal, with both values above zero. Furthermore, the CCI should exceed the sell CCI threshold, typically near the overbought area, and the volume should be above zero. Finally, we use the leverage function to enable trading with operational leverage. If you're interested in the complete code for this algorithm strategy, refer to the description below. Next, we'll discuss the backtest results. After backtesting different leverage levels, the results are as follows. When examining these backtest results, if the goal is to follow a stable and low-risk strategy, leverage level 1 may be the best option as it has the highest Sharpe ratio. However, if the aim is to achieve the highest profit, leverage level 6 could be considered. This level yielded the highest profit of 521% over 6 months of backtesting, with an acceptable drawdown of 24%. It's worth noting that this drawdown only lasted for 1 day and there was consistent profit every month. Next, let's delve deeper into the strategy using leverage level 6. We're utilizing the backtest command on a 5-minute time frame, while including 1-minute detailed intervals to obtain more realistic and accurate backtesting results. This approach allows us to simulate trading conditions and the performance of our algorithmic strategy with a high level of precision. Our trading strategy involves 20 pairs. A review of the backtesting results indicates that 17 out of these 20 pairs are profitable. This is a promising indication of the effectiveness of our algorithm and its potential to generate returns in a live trading environment. Considering the total number of trades, we executed 531 trades throughout the backtest period. Out of these, approximately 66.9% were winning trades. The majority of our profit comes from the ROI function, a robust mechanism in algo trading. The ROI function sets a specific profit target for each trade, allowing us to exit positions as soon as they reach a predetermined level of profitability. This way, we can secure profits and reduce potential losses from market reversals. Looking at the monthly performance, our strategy has shown consistent profitability. This is an encouraging sign, suggesting that our strategy can adapt to different market conditions and continue to generate profits. In terms of risk-adjusted return, this strategy exhibits a Sharpe ratio of 13.16. The Sharpe ratio is a measure of risk-adjusted return, and a higher value indicates a better risk-reward payoff. Furthermore, the profit factor, another key performance metric, stands at 2.54. The profit factor measures the gross profit relative to gross losses, and a higher value is preferable as it indicates that the strategy's profits outweigh its losses. This strategy executes, on average, about 2.9 trades per day. This frequency highlights the balance our strategy strikes between being active enough to capitalize on market opportunities and not overtrading, which could lead to increased transaction costs. In terms of trade duration, winning trades typically close in approximately 2 hours, while losing trades take around 9 hours to close. This discrepancy suggests that this strategy is effective in quickly capturing profitable opportunities, while allowing more time for losing positions to potentially turn around. Reflecting on the broader market performance over the past 6 months, the market has grown by 187%. This means that if you bought and held these 20 pairs, your profit would be 187%. However, by applying this strategy, the returns could be significantly higher than those gained from a simple buy and hold approach. This underlines the potential value of algorithmic trading and the particular effectiveness of this strategy. Finally, let's examine the profit plot. We optimize the parameter using a portion of the data, specifically the left side, then test it on future or unseen data, which is on the right side. When using this strategy, the combined profit appears smooth and demonstrates a consistent upward trend, indicating successful trades over time. There is a noticeable drawdown in the profit line, which is expected in any trading strategy. However, what is important is that recovery from the drawdown is evident, showing the strategy's resilience and ability to bounce back from losses and continue to generate profits. This concludes the discussion on this strategy. If you find this strategy interesting, I encourage you to conduct your own experiment. If you have any ideas or suggestions, please share them in the comments. Remember to use multiple strategies at the same time to reduce risk. Thank you for watching and for your patience. See you in the next video.